I'm going to take a few minutes to talk to my audience on that because there's so many of you out there that have wanted to support Church Alive, and we have done some great things from feeding the hungry, to clothing people, the immigration services, and whatnot, and on and on and on. And we want to keep our ministries going, and but we can't unless you continue to contribute to us. And I want to ask Mr. Thompson to go back and to tell you how important or what is the impact on your tax returns when it comes to contributions, charitable contributions. Now, I'll say to you, if you give us $1, we're going to give you a receipt. So don't worry about that, folks. But we want not only for Church Alive to be helped, but your church and your ministries and all those that are making a difference in the lives of people, they need to continue. Because the government fades away, the church is always going to be there. And the only way the church can respond to the emergencies or the issues that you face is that you must continue to contribute to a quality nonprofit organization. And I'll say it again, just like Church Alive. But what are the benefits of a contribution?
Well, the benefit of a contribution is that you get the tax benefit to the extent of your tax rate. So if your tax rate is 15%, then 15% of whatever you gave, let's say it's $1,000, then 15%, $150 is the actual tax that you actually save on your taxes. If your tax rate is what is normal, which is 30, 40, 50% in some cases, then if it's 40%, you're getting $400 in tax savings, tax credit, as a result of that contribution. And also, by making contributions, it probably will put you in a situation where you're able to itemize your deductions. Because if you have to be over a certain amount, which is the standard deduction, which varies anywhere around $7,000 to $8,000 per individual, depending on whether you're single or married. And if you have contributions that you've made, then you're able to itemize, which means you can itemize other deductions as well. Be able to itemize your medical expenses, your unreimbursed business expenses, casualty losses. And if you have a home, then definitely you're able to include that with your mortgage interest and state taxes as well to ensure that you pay less taxes. So contribution, not only from a personal gratification standpoint, is a good thing, but it's also it's tax beneficial to do that.
Now, are you available? We talk a lot of things, and many people, they need to know, can you help them? And this is a good time to come to your office.
Well, most definitely. We're a tax planning and financial services operation. We help clients reduce their taxes. We help them to keep more of what they earn and reduce their taxes and pay only what they're entitled to pay. And so coming to us right now would be the ideal time to look at your tax situation. We can do a tax projection and determine what areas you can improve on with the goal towards reducing your tax.
Now we're going to go into two other areas, and one of them is stock losses and 401 contributions.
Right,
Mr.
401k contributions. We are very much, Reverend, as you know, more than any other time in the past several years, the economy is at its worst level, and it's reflected in the stock market. So most individuals that have investments, whether private investments or it's qualified investments, especially those that have investments in their 401k plans, have experienced some kind of a reduction in the value of those assets.
Assets, right.
And therefore, while that is happening, from a tax standpoint, you could employ certain tax strategies to further reduce your taxes. Depending on the individual situation, it may be a strategy whereby they may have capital gains during the year from sales of other investments early on, and they can reduce that with capital losses. For any gain that you have experienced or have, you can reduce that dollar for dollar with capital losses. So if you have investments that are losing money right now, actually sell those investments, compare that and match that loss, integrate that loss with that gain, and reduce that gain further. Now, there are opportunities here whereby you may say, look, I have this investment, but I really think this investment long-term is good. I really want to keep that. Well, there's an opportunity whereby you can sell that investment, use those losses to reduce your taxes, and get back into that investment 30 days from the day that you actually make that sale.
So if they did it now in '08,
Yes.
okay, in '09, they can go back and purchase that again. In other words, sell
Yes.
it, get the deduction,
Right.
and then go back into the market
Right.
in '09.
Within a 30-day period.
Right.
It has to be a 30-day
30 day.
gap.
Oh, I see what you mean, a 30
Yes.
period.
That
So
30
from
day
the date of your sale,
From
30
the date
days.
of your sale, then you have to wait for 30 days before you can repurchase that same investment or a similar type investment to be back in that particular investment vehicle that you would like so much.
I guess these are some of the loopholes the millionaires have. And you're
Yes,
sharing with us some heavy stuff,
it's been
man.
used very common by the rich and famous and by the wealthy. We want everyone to have access to those opportunities.
Well, this is
and
what
that's-
God wants, you know?
That's right. And that's what we at TaxPros Financial help to provide.
So when you see in the market everybody selling and selling, they're selling for a reason.
There's a strategy behind that.
It's a strategy. And then they turn around and the market goes up, everybody starts buying.
That's right.
They know what they're doing.
Exactly.
And we are now telling you folk how you can tap into this wealth of information. That's the
right.
key.
That's
And
right.
then be able to utilize it to your best. Thompson, this is great information. I don't know about you folk out there, but this is great information for me. And I know out there you're getting it good also. All right, we're going to deal with the consequences of foreclosure. And then we're going to also drift into the area of common unknown deductions. We just mentioned one just now, but there are other commonly unknown deductions. But first thing, foreclosures.
Right. Okay. Just before I move on to foreclosures, Reverend, you talk about 401k contribution. I just want to elaborate on that a little bit.
Yeah.
In that, for individuals, this is a strategy for reducing their taxes as well. Is that if they're not part of a pension plan, they can create their own pension plan by contributing to what we call individual retirement account.
Oh.
They can put up to $4,000, which is in their own account, and get a tax deduction for it in 2008. And if you're a small business, you definitely want to have your account set up by December 31, and that's what the importance of getting together before the year end exists to ensure that those things will apply to you and you can benefit from those particular rules and regulations that are currently in place for pensions on the books. Talking about foreclosures, as you know, this is a challenge that's facing various individuals throughout the country, but it's also a challenge for our country because it's probably one of the most significant aspects of the downturn in the economy, and hundreds and thousands of people are losing their home on a daily basis. But there are tax consequences of that for those that own homes and for those that are making investments. On a normal basis, if you have a foreclosure, you may have what we call a forgiveness of debt or a cancellation of debt, and that may accrue into taxable income in which you have to pay taxes on. Even though you lost your home, you may still be required to pay taxes on the gain on the foreclosure of your home. Now, in 2007, we have what we call the Mortgage Relief Act, whereby people that had their home foreclosed on may not have to pay taxes on the cancellation of the debt or the debt forgiveness. So if you own a home and it was foreclosed on between 2007 and 2012, you're not going to be able to pay, you're not going to be required to pay taxes, income tax, on the gain on the foreclosure should you have a gain.
Okay, now this is something where people need to get technical assistance. They need to come into your office.
Right.
And because there are many people out there every day foreclosure, and if they don't know that, they may end up really going through a real tragic situation when the tax situation comes up. So are you available to help them in this area?
Definitely. It's a very technical area, and it varies depending on the person's situation, whether they have a primary home that's foreclosed on or they have an investment property that's foreclosed on. Also, whether or not the property was the primary security for the home or whether or not they were personally liable in the home. All of these factors determining the actual tax impact of the foreclosure.
Okay. Now, there are two areas I want to put together here, and that is commonly unknown deductions and earned income tax credit.
Right. there are a number of deductions